turn to, you had some comments on passive investing. Can you explain what that means and whether it will continue to do well?
Absolutely, Mark. So one of the big trends throughout the last 7 or 8 years, market recovery, has been this massive shift from investors to index funds, cheap ETF funds, passive investing, as you mentioned, and out of more actively managed managers, whether it's mutual funds or other types of active managers. And frankly, a lot of that tends to be herd mentality. It tends to be chasing what's worked in the past. And some of these things you have to be careful of. One of the reasons why passive investing works so well over the last 7 or 8 years is because everyone was focused on policy, particularly monetary policy. If you look at really the period after 08, 09, when the Fed embarked on its massive QE program, correlations, whether it was in global asset classes or stocks or you name it, really went much higher versus their history. They were trading at elevated levels, as you can see in some of our analysis. And in that type of period, Mark, where a lot of stocks and sectors and products, asset classes are trading very alike, it's very difficult to make idiosyncratic, active, fundamental stock picks or asset allocation picks. Now, that's all changing because, as we talked about earlier, the Fed is unwinding its stimulus. Europe is potentially thinking about unwinding its monetary stimulus because growth is getting better there, as we discussed. And as such, correlations, really starting after the Trump victory, correlations have been dropping dramatically the last 6 to 9 months. And what by the way, has happened in coincident to that? Active management is starting to perform a lot better versus the last 3 or 5 years. So we talked a lot about trends today in terms of, U.S. versus overseas, in terms of some other themes in terms of the U.S. Cap sizes, small cap versus large cap. And it's important as a client or as an investor, you need to think about also how do you maximize your fees as well. In periods where markets are really going straight up with not a lot of differentiation or high correlations like the last 6 or 7 years, you can really do fine by paying cheaper fees, by paying lesser fees for these passive investments. We don't think the next 3 to 5 years is going to look like the last 3 to 5 years. We think that we're going to go from record low levels of volatility to higher levels of volatility, and we think that this drop in correlation augurs for better fundamental performance from active management. So that's something we would also focus on in terms of our conversations with investors.
Okay. So from this, I take that you want to stay invested, but now the market won't be the same. It's going to be more variable and uncertain, and that's when you need a potentially different approach.
You want to stay invested in terms of the U.S., where we think we have 10% upside. We think we have more upside overseas markets like Europe and in emerging markets, even Japan as well. We think, we haven't talked about Japan, but we think after lagging for much of this year, we think Japan looks interesting as their earnings recovery and growth starts to improve. But to your point, it's always difficult to time the market. A lot of folks have the confidence or have the opinion that they can get out of the way or avoid 5%, 10% dips, and you may be lucky enough or smart enough, frankly, to do that once. But guess what? You also have to get back in. And that's really the thing, is that 5, 10% dips are frankly really common, Mark. You tend to see them once, twice, 3 times a year, every year. What's more uncommon, really outside of the incident or outside of the scenario of recession, is those big 20, 30% dips. And that's really where Morgan Stanley, if we thought that there was a 20 or 30% type downdraft or correction on the horizon, that's where we would become more negative in terms of our positioning. We're not there yet today, but we always try to caution or advise clients and investors and our financial advisors to try to be somewhat nimble, try to be somewhat tactical when you do see these slight corrections in the market. Some of those tend to be buying opportunities. You don't want to sell or knee-jerk sell on some of these headline risks. Because like I mentioned, the negative effect of missing some of those best rebound, best rally days in the market, that can really hurt your returns longer term. And we've done a lot of analysis to support that.